All right, welcome to another episode of Millennial Money Matters with Kelly and Derek.
Hey, everyone. Welcome back.
Welcome back. We kind of have an exciting episode this week where we're going to be talking about a lot of stuff that's happened in the world in the last couple of weeks.
Yeah, it's election season, so rightfully we have our new president-elect. So we wanted to talk about, he talks about all these policies, the few that he's actually talked about, and what do they mean for you individually?
Yeah, there's been a lot of buzzwords. I think that I've heard the word tariff more in the last 2 weeks than I think I've heard in my entire life. Maybe like history class in high school was the last time we were talking about tariffs, but here we are, 2024, tariff is the buzzword.
Yeah, Mr. Trump loves tariffs.
Yeah,
we're going to talk about that today.
But there's been a lot of chat about tariffs, tax cuts, interest rates, the feds, economic policy, foreign policy. And I think there's a lot of questions for people about like, okay, cool, we hear about all of this. We know this is all going to alter the economy in some way or another, but like, how does it impact me as a person, right? I'm an individual. I want to talk a little bit about, right, how does that impact us? Because, right, what am I worried about? I'm not worried about tariffs from China. I'm worried about paying my childcare bill, paying for like T-ball sign-ups start in a month. I'm worried about that. We're worried about our kids' 529 plans. You know, our worries are a little bit different. And do we have to worry about some of this policy? Is it going to help us? Is it going to hurt us? And I think that's what we're going to dig into today.
Yeah, I always talk with clients, there's two economies, right? There's the economy writ large, and then there's your economy. So I think our connection today is what's going on in the economy that can potentially impact you personal economy, right? And that's what we're going to really dive into.
I love it. That's a great segue into this, right? Your personal economy. I've never thought of it that way. We talk about budgets, we talk about a lot, but your personal economy is, it's how you run your personal finances and all the different impacts of it.
Yeah.
What a great thought.
That's what I'm here for. All right, I'll see you later.
Yeah, Derek is done now. Derek is done now. Oh, you've sort of just blown my mind with sort of that concept that, it's your personal economy. All right, so what's our first topic? What are we going to talk about? I'm here to just ask questions, not to give answers. That's what Derek's for today.
Yeah, sounds good. So it's, I guess, most of my show today. Well, I think the big news that we saw immediately was the impact on the stock market.
Yeah.
You just mentioned to me how now you're all a multimillionaire now because the stock market went up 20 points.
It felt good for a few minutes. I was like, oh yeah, there's a lot going on there. But I was saying to Derek before we started recording that stocks going up really quick and going down really quick are both nerve-wracking to people who kind of have a financial savviness, and when you see your stocks or your investment accounts blow up, you're like, oh, that's good, but, and like what happens next? And same with, right, when we watch them like blockbuster drop, you have the same feelings. You're like, oh no, like impending doom.
That can't be good. Like that can't be good either way.
Either way. So I am feeling a little that can't be good because what goes up must come down.
Yeah, generally. So one of the things that I think people don't necessarily always understand about the stock market in general is they are a leading indicator and they try to be forward looking. So they're not looking at like, all right, what has happened and we're going to react based off of that. They're trying to think, okay, this event is happening. How are we going to price that in the future, right? So they're assuming Trump is going to be really good for stocks. And there's a couple things that he's mentioned that would probably, go along with that. So the first thing is he's talking about cutting the corporate tax rate.
Oh, yeah.
Right.
So big companies love that.
Yeah. Well, because, think about it, just $1 less that you have to pay to someone else that you can use to either reinvest or buy back your own stock or give your own shareholders in dividends, right? So he's proposing going from 21% to 15%.
That's a big difference.
And yeah, keep in mind that before he got in office the first time, it was at 35%. So this is a huge cut from when he even first was president.
Wow.
Right, so it's a big drop,
That's
right?
a big difference.
Yeah, so 6% doesn't seem like a lot now, but look over that. And one of the things that I kind of saw this chart, it was talking about like what do they do, and a lot less companies after the first tax cut borrowed less. They bought back more of their own shares. So like I said, it kind of once again just frees up dollars. So anytime you free up dollars for a corporation to use however they want, they're going to either typically reinvest it. Hopefully, that's the thought process there. They're going to buy back their own shares, which helps the stock price. Doesn't really help anyone else unless you're a shareholder. Or they're just going to increase their dividends. So that's generally what companies can do with excess cash anyway. So that's what the thought process behind why the stocks are going up.
Now, just quick question, just for clarification. That's like the altruistic things they can do with excess cash. But this was also a time period where CEOs and management of companies were making the most money that they've ever made before. So some of that money does end up in the pockets of the personal stakeholders for a large company, right? Like your CEO can bonus themselves out, $45 million instead of $35 million, which doesn't, when we're talking 45 to 35, doesn't sound like a huge difference until you're contemplating the entire country's GDP that, that can account for in other places.
Well, interestingly enough, this is a problem that went back to Clinton. And he actually was probably one of the reasons that he solved this, because one of the big changes that during his administration was a lot of executives had more salary in some stock. It wasn't a huge mix. Now it's mainly stock. So when you have these CEOs, these C-suite executives at these large companies making $45 million, but that $45 million is mainly company stock, what are they thinking? We got to drive the stock price. We got to
make this stock price baller. That way, that's coming in my pocket later.
Yeah, I mean, yes, there are shareholders that if you are invested in a company, you're going to go along with it. Most people don't have $45 million a year of income that they're pumping into the stock either, but they have so much wealth tied up in their own company stock that they are driving a majority of those decisions. I mean, the good CEOs are looking long term. The bad ones are going to be, how do we take advantage of this right now? And a lot of that is just buying back your own shares. And what that does is, let's just say there's just easy math. Like, let's say there's 1,000 shares available out there in the market, and they say, okay, well, we have to pay a dividend of 2% to all these 1,000 shareholders. Well, then they go, like, we're going to buy back 200 of them. So now there's only 800 shares. So now we have to pay less in dividends, right? Now we have more money coming back to us. There's less shares. There's higher demand for the stock because there's less supply. It's this nice little thing that they can do is they're just using company money and excess cash to reduce the amount of shares out there.
So it's smart for the company.
Yeah. I mean, it's not the best economic thing, but it's going to be good for shares. That's why you see, some people on the other side of the aisle saying, hey, we love to tax buybacks or get rid of them. They're evil. I don't think they're evil. I mean, sometimes a company has to do what they think is best for the company.
Yeah.
And sometimes that is buying back shares.
Interesting. Ooh, things that you never contemplate.
Yeah.
Or you contemplate. Those of us dealing with our own personal economy are not necessarily contemplating that.
Well, I always think, hey, just in my life, what I've learned is just follow the money. Like, where is the money taking us? And that'll give you the answer.
That'll give you the answer.
Yeah.
All right. So
where's the pot of gold? And the other thing that people always talk about is the Trump trades, right? Because they want to think, okay, now what industries are going to be more impacted by Trump and by Biden? So a lot of people are trying to guess. So some of the big sector winners were financials, technology, energy, and then outside of the sectors, so sectors are part of the economy where it's like, hey, we're looking at the technology companies, for example. Then there's what's called small cap companies. So these are not the big boys on the block. These aren't, Apple, GE, all those folks. These are generally more startup companies. They tend to have more debt, but they do less overseas. And if he's talking about implementing some of these tariffs, which we're going to get into later, that's typically going to be better. Probably they're thinking that's going to be better for local companies that do majority of their business locally in the United States. So that's why small caps went up. And the other thing he's been championing lately has been cryptocurrencies. He went from not understanding it to still not understanding it, but at least now championing it in general, saying, hey, look, crypto. So if you look, crypto's gone up. And he's even talked, I've heard, about buying some crypto for the government as their reserve.
Oh, we're totally legitimizing crypto at this point.
I mean, we'll see about that if that actually happens, but that's what the crypto folks are betting on. They're like, oh, maybe the government's going to buy some crypto, and that's why the price has shot up like crazy lately.
Okay. So we're going to buy some Dogecoin and Bitcoin and...
Well, Elon's got his right here, so maybe it's going to be a huge amount of Dogecoin. So,
ooh, Dogecoin. What?
Yeah.
I can't. Okay. All right. All right. I'm listening.
Follow the money, Kelly.
Follow the money.
So that's kind of what's going on with the stock market. So the stock market writ large has kind of said Trump's going to be good for the stock market specifically.
And that's why the reactions are very positive right
now.
Yeah.
And that's why they shot out of a cannon right after he was elected, right? So what they're doing, they're trying to price in future growth. Now, the question is that future growth sustainable? Where do we go from here? Are we going to go up because, everything he says is going to come true and the economy is just going to boom and tax rates going to be nothing, or are we getting ahead of our skis? And that's the question. No one of us really know for sure.
No, we'd be Warren Buffett, right? We'd be gajillionaires and sitting on our pot of money if we knew the answer to that. But I do think, I said it right at the beginning, what goes up always comes down, and not necessarily volatilely. Well, kind of volatilely because that's the life we're living right now. But I always feel like initial reaction is always extreme, and then there is some settling that happens, right?
Yeah, well, you want to think of it like water, because water seeks its own level. And the level that it seeks is going to be based on earnings when it comes to stocks. So short-term news, long-term, they're going to look at, all right, is this company actually making money for us? Cool. We're going to give it more money so they can make more money for us. It's going to be more valuable, right? So if they're not earning a good enough amount of money, then you're going to have those drops. It was kind of the same thing that happened during COVID, right? Like all those, we were projecting all the, what was the exercise bike? I'm blanking on Peloton.
Peloton. Everybody wanted their Peloton.
Everyone bought a Peloton. It's like, this is going to go on forever. The stock shot up. And then what happened? People actually started going to gyms now.
And now people like can't give away their Pelotons.
Exactly. So that crashed. Like that didn't sustain itself. It's, it sought its own level there because the earnings weren't keeping up with the stock price. So that's the one thing we need to be worried about. The other point I would make is there was a lot of Trump trades back in 2016 which didn't work out. Like if you had a guess, or you had Joe Biden, you had Trump, right? Who would have been better for oil stocks?
Yeah, I would have said Trump all day long.
All day long. Biden was much better for oil stocks.
Interesting. Okay.
Right. So sometimes we assume these things are going to happen because someone's president, but there's so many other factors that are going on outside of the president's control that are going to impact the stock price.
Yeah. And that, my only real relation to that is interest rates, because that's the life that I live, is that people are always like, oh, well, what's happening and why are interest rates going up? And sometimes interest rates go up due to the United States' own economic factors, but sometimes it's outside factors. It's what's happening, like the war in Ukraine had a big impact on interest rates. Like it is outside factors that we cannot predict. And I think that's probably one of the messages here is no matter what Trump or any other president does or does not do, there are pieces of this puzzle that are just completely outside of anyone's control. They're happening somewhere else.
Yeah. I mean, my advice for the stock piece of this is don't go crazy with the Trump trades. If you're a long-term investor, stay long-term invested. He's only going to be president for 4 years. He's probably going to have control for 2, right, on the Republican side. So not all this stuff is going to come to fruition, and it's not going to come right away. Just have a long-term outlook with a lot of these stocks and don't go crazy overweighting one or the other. If you want to, do a little bit of your fun stuff on the side, go ahead and do it. Just make sure it doesn't impact you totally financially.
Your long-term plans.
Yeah.
Here.
And then kind of think maybe we should probably jump into bonds because that's kind of what we had mentioned with interest rates, right? Because that's, you're in the mortgage business, and what did you see with mortgage rates? They must have gone down because the other thing that kind of just slipped in this week was the Fed dropped the rates again.
The Fed dropped the rates again. Yeah, the week of the election. I can't even talk because I'm so overwhelmed contemplating it. Was like a wild week in interest rates, in that we had the election news that we were waiting on, which we knew was going to have a large impact on interest rates, and that was immediately followed by a Fed meeting. That was kind of a controversial Fed meeting. I don't want to say controversial. I guess that's the wrong word.
No, say it. We need more views. It was so controversial.
It was a controversial Fed meeting. There was just a lot said in that Fed meeting.
Yeah.
And so we actually watch interest rates drop initially, and then we watch them spike back up, and then we watch them drop. And honestly, we're seeing daily a lot of volatility in the bonds on the interest rate side. So I think it's, again, a lot of people thought that, as soon as the election happened, rates would settle down. But again, there's more stuff at play than just an election. And I think that's one of the tricky parts in bonds and in interest rates is it's not just one thing that's impacting us. It's a lot of little things.
Well said. And one thing I would add to that is also the bond market tries to be future looking.
Mm-hmm.
So they're looking at a lot of these policies and saying, okay, if we do all of these things that we're talking about, what's going to happen with the deficit? Is it going to go up or down?
Yeah.
That's going to go up. Okay, so now, because we base a lot of the rates on the 10-year Treasury,
yep.
right? And they're saying, okay, well, if the deficit goes up, and there's maybe some potential inflation coming down the pike, which we'll probably talk about later, should rates be higher or lower? So they're like, oh, it's a little riskier because all this inflation and all this debt is going to happen. So that's why rates shot up, even though the Fed has dropped the rates.
Yeah. And the other thing that happened with that, too, is what is more important than whether or not the Fed drops the rates is the actual commentary from the Fed meeting. So that's the stuff that has a bigger impact on us. And there was some commentary from that Fed meeting from our Lord and Savior, Jerome Powell. Lenders love and or hate him, depending on the day. But he had some commentary that did make it sound like some of the future cuts that we thought we were going to get, we may not be getting. And so the bond reacts to that kind of somewhat drastically. So we think that was also some of the spike that happened where rates went back up again is cool, you drop the rate right now. But if you said you think you're not going to drop it again, or you might raise it, then all of a sudden everything reacts accordingly. So it's not necessarily about what's happening in that moment. And a lot of people don't realize too is all the speculation around if the Fed is going to drop the rate or not is generally baked in to any given bank's mortgage rates for weeks in advance.
Yeah.
Like we knew we were going to have this rate drop from the Fed. So that had already been baked in because when you're locking an interest rate, you're locking it for 30 days, right? So if we think you're going to drop it within 30 days prior, that the rate is going to be impacted by it. So it's not necessarily that something that's hitting that day. It's really already been discussed, looked at, vetted, and baked right in.
Yeah, because they want to try and predict what's going to happen because they don't want to have set a rate and say, hey, look, it's going to be 5% and the rate goes up to 7%.
Yeah.
I mean, extreme, but like that's not where they want to be. So they're going to look ahead and they're thinking, okay, there's what happens at the Fed meeting, which is what they cut rates, and then also what the Fed says.
Yeah, what they say. Their words are very important.
So they're trying to read into that, and if they're reading into it and saying, okay, because they're very data driven, and they've been a little slow to move. So they're going to say, okay, well, if these policies are inflationary, should we be cutting rates as quickly as we plan on doing?
Yeah.
So they're going to maybe slow roll it because basically the expectation was we do a 50% cut and then a 25% and then maybe another 25% before the end of the year.
Yep.
So basically dropping it down by 1% before 2025 hits. Who knows what's going to happen with that one? So that's a little bit more up in the air than previously expected, and that's why the rates have also shot up because they're trying to once again predict
exactly what is going to happen here. And the other thing too, just as a quick aside for those listening, if you're not familiar, when the Fed drops the rate by say 1%, that does not mean mortgage rates are dropping by that amount. So that is a slow. I think we've talked about it a little bit in past episodes, but it's like a slow trickle into mortgage rates. It is not a 1-to-1. So the Fed dropping by a quarter point does not mean your mortgage rate is now a quarter point lower. Not how it works. There's a lot of other factors that come into play with your interest rate, but just know that it's not. Feds don't cut rates and then your mortgage rate is cut by the same amount. Right. We get that question a lot.
I'm sure. Yeah, and it's just there's a lot that goes into these things. It's not like, oh, boop, 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 one thing when it happens, here we go. Should we move on to taxes?
Yeah, let's talk about taxes because everybody loves to talk about taxes. It's my favorite topic. I hate it. So.
Well, this was as me put my financial advisor hat. We're always talking about all these other things that's going on in the market to me, or the election. And to me, the one big thing was what's going to happen with this massive tax bill that Trump passed that was set to expire. And for those that don't know, the Tax Cuts and Jobs Act basically was going to a few main categories are going to be impacted. So first of all is your income tax rate. For most folks, it would if they just let them expire and nothing happened, tax rates would go up about 3%. Depending on your tax bracket. So that's one. So yay, more taxes. All right. So long-term capital gains rates would stay about the same. So that wouldn't be changed. Standard deduction, which everyone's kind of, no one itemizes really right now. So that would be cut in half. So more people would potentially start itemizing. So there'd be more planning along that. The SALT tax was capped at $10,000. That would be removed. So if you were moving to itemizing and you had a big house with a big interest payment and a big tax payment, you could deduct more of it. So a lot of people would be happy about that. The child tax credit would have been cut in half. The mortgage interest deduction would change as well. And then some of the big one for those that are dying, the estate tax would be cut in half as well. So it would be at $13.6 million now, down about $5 million.
Oh.
Adjusted for inflation. So it could be around $6 million by the time. So there's a lot of big changes that would happen if they just let it expire. Now, what we think is going to happen is Trump said basically we're going to keep these deductions moving forward. So we're gonna kind of make everything permanent as permanent can be in
the
Congress.
Government. Yeah, it's not that permanent, but a little permanent.
Yeah. So the good news is for everyone, the tax rates are going to stay the same. So they're not going to go down. You're probably going to hear tax cuts. No, they're just going to extend them. So
you're already living in the tax cut. You're just going to get to keep it for longer.
Yes. You're staying in the same depth of water. You're not going higher or lower.
Okay.
Right?
I like all these water references. They're delightful.
Thanks. I guess I saw Aquaman the other day.
Right,
or something.
apparently.
Yeah. So for a lot of people, and what I would say is, we got these tax cuts coming, or tax extensions coming, I should say. So what do we do for planning? And what we really want to think about is where are we today versus where are we historically, and what's going on with the debt, and where do we think we'll be in the future? So Kelly, I'm going to do some trivia and see if you know.
I
did not prep her for this. So
I'm not prepped at all. Feeling anxious.
It's okay. You'll get it wrong. It's okay.
Okay, cool.
What was the highest marginal tax rate?
I don't even know what that means.
History.
You spoke Spanish there. Okay, thanks.
All right. So right now it's 37%. So if you make the most amount of money, you're going to tax for every dollar you make, you're going to get taxed 37 cents.
Okay.
So what do you think the highest one ever was? in our country?
56.
56. You're very wrong.
Okay, I just made it up.
I told you, it's fine. It was 94%. Wow. So you made $1, 94 cents went to the government.
Okay, all right. That was not a great time.
Well, that was right after World War II, so we had a thing to pay for. We had a lot of tanks.
We had a very expensive thing to pay for.
Tanks and cigarettes back in the 40s to pay for, right? So, so if you look at that, and we look at where tax rates are basically historically low. They haven't been this low since, I think, before the Depression. And then you have all this debt. Like, where do you think taxes are going to go?
Yeah, they're gonna go up because we got to pay for that debt.
Well, a reasonable person would say that. I don't know if we have a reasonable government that would ever pay for that, but who knows? So let's say that does happen at some point in the future. So when it comes to planning for you specifically, we want to think about things like, okay, are Roth conversions more in play? Should we be putting more money in Roth that's not taxed now, or that is taxed now but won't be taxed later? These are a lot of the conversations you want to be having with your CPA and your financial advisor, because all these tax things right now are going to still be in play. Right, so you want to keep taking advantage of these low rates now.
I'm making blank faces at Derek because this is where things start to sound like, for me, like a little anxiety inducing. But I get the message, right? For like, okay, the average consumer in their own personal economy, because I'm sticking to the personal economy. This doesn't all have to be bad as long as you're thinking forward. And I think a lot of people think right now, what's best for me right now, but you really need to be thinking what's going to be best for me, like future Kelly, what's going to help future Kelly as opposed to Kelly today.
Right, because most people are taught to just let's save taxes, right? Because no one likes paying a high tax bill.
Correct.
It feels good when your accountant says, "Hey, look, I got you a $5,000 refund last year. You got a $3,000 refund." You're like, "This guy's the best.
That's my free monies."
But what if you're paying 24% today? In the future, you're paying 35%. That's not a good tax plan.
That's not a good tax plan.
You really want to kind of think about, okay, if I stuff all this money in a pre-tax bucket, pay a lower tax rate today, but now I've got this tax time bomb coming later on, and I'm going to be taxed at 35% later.
Not the best
plan. That was not the best plan.
So
long term.
Long story short, taxes don't have to be good or bad. Either way, they're different for everybody. And you need to speak to your professional who knows your personal financial situation to determine the best way to sort of combat where your money's going.
Exactly. But if we're thinking logically about this, tax rates are my best guess is that tax rates will not be lower than they are today.
Okay. All right. I'm down with that.
So use that for what you will, but talk to your professional about it. So that's one way I would look at the taxes for you. And the big other T we're talking about is tariffs.
Tariffs. This word, man, I told you, like, is this like the Boston Tea Party? Weren't we? I don't even know. I'm making stuff up. But like tariffs are a word that you hear very rarely it is the buzzword of 2024. If you were to say like, Kelly, what is the word of 2024? It would be tariffs.
Yeah. And you know what the funny thing is? You know what the Google search for tariffs?
I don't even want to know.
After the election, not before. After.
So after people already made their choices. Okay, yes, cool.
So the search results or the search queries went up 1,650%.
What? Because it's a word that's been used a lot, but we don't all know what it means.
And then the question, who pays for tariffs, is up 350%.
So Derek, who pays for tariffs?
You're looking at them. You and I do.
We pay for tariffs.
Yeah.
I thought other countries paid for tariffs. Isn't that what we're being sold right now?
Well, technically they do.
Okay.
But anyone running a business knows that if my cost of goods go up, or let's say my labor goes up, whatever, my prices go up, I'm going to pass that off to the consumer. As we saw during the whole inflationary area a couple of years ago.
Oh,
right?
yeah. Things got expensive, so everything got expensive.
Yeah. Like the supermarkets were just eating that cost. The car companies were just saying, oh, we're just going to sell the Ford at the same exact price. We're going to make the prices go up. During COVID, lumber went up like crazy, right? So basically what's going to happen is, let's say you've got an item that costs $100. Let's say it's a drill, right? $100 drill. Now, depending on where it comes from, basically the plan or the thought process is, all right, we're gonna put 60% tariffs on Chinese goods and 10 to 20% on other trade partners throughout the world. So pretty much everyone else.
Everyone else.
So all right, let's use a drill from China versus a drill from Mexico. Let's say that's 20%. So that $100 drill from China now potentially becomes about 160 because they're just going to pass that.
Onto the consumer.
China would pay this 60% tariff to the U.S., but then the consumer now says, okay, now my drill costs $160 roughly, right? Same thing. Now that drill from Mexico is going to cost 110 or 120 depending what the tariff is. So you get a pretty big increase. The thought process behind that too is like, hey, we want to bring manufacturing back.
Yeah,
Right,
which I get that in the consumer standpoint, right? As we've been encouraged for years, right? Buy made in American, buy made in America, read your labels, where are things coming from? And it's a valid conversation about the quality of goods, the safetiness, safetiness, is that a word?
That's a real word, yeah.
Okay, great. The safetiness of goods, where things are being manufactured, that the sort of travels that some of our goods go on, right? That like product can have a material that's sourced in one country that's then sent to another country, and then it's processed partially in that country, and then it moves to a third country, and then more of it's processed until it finally ends up in our hands. And that's like convoluted and expensive. This would maybe combat a little bit of that.
Yeah, and that's the theory behind it. It's either, hey, we're going to use this as a bargaining chip, or we're going to try and get some manufacturing here. But Trump did put some tariffs on the first go round, and manufacturing actually decreased.
Okay.
So they've not proven that tariffs are one for one. Hey, we're gonna bring things over here, because I mean, you still have to build. Let's say you don't have a drill factory here, you're gonna have to build a new factory, and like that's gonna be expensive, and then you got to hire.
Is it
people.
worth it to just pay the extra $60?
Do I just pay the extra $60? Right. That's kind of what you were thinking of too. So
I didn't contemplate that, right? Yeah. So it's not just a matter, right? So it costs $60, right? For your $100 drill is now $160. Cool, you can manufacture it here in the United States. If there is not a facility to do that, is it more cost beneficial for a company to pay the $60 or to build the plant?
And the other thing is, well, two points, right? Tariffs can be temporary. We have no idea how long. So if you're going to plan out, all right, I've got to build a factory. It's going to take me 3 to 5 years to build this factory.
Oh, yeah.
What if the tariffs are gone by then?
Okay.
So is that a smart business decision, right? The other thing that a lot of people don't realize, so the Tax Cuts and Jobs Act, that's going to have to go through Congress. Congress has to approve that.
Okay.
Presidents have a pretty much carte blanche power to implement tariffs.
So that is a given. That's going to happen.
That depends. I mean, I don't know if the 60% is going to happen. I have no idea, but there is a greater likelihood that a president can implement a tariff.
Okay.
Than they can change the tax code.
Interesting. We're getting presidential history lessons too. I love it. I'm here for this.
Yeah. So that's one thing to think about. So I mean, basically, depending on what study you're looking at, and I've come across, but they're saying generally the extra cost to most Americans is going to be between $2,500 and $3,900 extra a year.
Okay. Wow. So not insignificant in your personal economy.
No. So and if we're combining the two, tax cuts and inflation, let's say we're going to get from tariffs, you're probably looking at a net negative of still $2,600.
Okay.
So even with the tax cuts extending out, you're still,
not necessarily winning.
Not ahead at all.
But if you make a lot of money, you might be ahead, right? If you're getting corporate tax breaks and all of that stuff. So it does depend a little bit on where your personal economy falls in the range of personal economies.
Yeah, well, so surprise, surprise, the people on the low end of the personal economy are going to be in much worse shape because of the tariffs than the people on the high end.
Yeah. Okay.
Right? Because they're going to get less of a benefit from the tax cut, and they're going to get more impacted by the increased prices.
Increased prices. But a tariff is not the same as inflation.
No, a tariff can cause inflation. It can be like a root cause of it.
Okay, but it's not the same. So we could see a decrease in inflation because that's what we're trying to do with an increase in tariffs. And that could maybe even equal out. So we may see not a price difference in our goods, but that would be.
Yeah, like once again, it's all going to depend on economies are complicated. It's not like you just do one thing. Like even the $60 example may not exactly work out exactly like that, right? But we get 17.5% of our goods from China.
Yeah, so that's a lot. Well, and I know like if you're, and I would venture to guess, we're talking, right, this is the millennial show. We're talking to millennials. Millennials probably get more of their goods from China than maybe other generations before ours, because we are the Amazon generation, where we love to Amazon things. And a lot of the stuff from Amazon is purchased from overseas. That's part of why it's so inexpensive. That's kind of the model of Amazon, is inexpensive goods from other countries. So that may be different than your parent or grandparent who's like maybe going to and like local economy, something we could talk about in another episode, but like going to like local mom and pop stores and things made in America. And it is a little bit of a there's a bit of a generation gap there.
Yeah, exactly. And the thing about whether these are good or bad policies, it's not up for me to judge. But one of the things I'd say, like, we have to start with the notion that there's no perfect policy out there.
Yeah, absolutely.
Right. So something's going to help some segment of the population and probably going to negatively impact another segment of the population. There's just no like, oh wow, we did this policy and there's rainbows and unicorns and everybody's happy. Everyone's babies are crying with happiness. Yeah, it's not applicable in real life. So we'll see the impacts of this stuff. We'll see how much will actually get done. I mean, with them controlling basically the Republicans were controlling about everything. They're probably going to get most of their wish list done. I mean, I've kind of noticed, I don't know if you have, but almost every president gets kind of one big bill that they can push out. So I'm curious to see which one it is. Is it going to be the tax cuts? Is it going to be something else? Because that's generally kind of their quote unquote legacies, right? Like what do they do? Like Obama was the ACA, George W. was tax cuts, Trump's first one was tax cuts. Is his next one going to be tax cuts?
Yeah, we don't know. And I think the other thing too is from like a lot of people have a lot of feelings about this election. So let's first off say no matter what side of the aisle that you sit on, your feelings are valid.
Yep.
And I also think that the emotions that come into play with an election, especially this particular election, make it really hard to look at data and fact, right?
Well, can I tell you like a crazy stat?
Yeah.
So Republicans, if Republicans are in office, they see the economy is 16% better or worse, depending if they're not. So they swing 16%. Democrats tend to swing 9%. So just depending on who's in office and if you support them or don't support them is going to color how good you think this economy is.
Oh,
regardless of how actually good it or bad it is.
Interesting. And that, I guess, makes sense to me. And it makes sense, I think, regarding a lot of the conversations that were happening leading up to this election. But yeah, I think, for those of you who are out there listening, I think the biggest thing as far as your money is concerned is don't just sit and wait for things to happen to you. Don't just sit and wait for tax cuts to, again, if you think these things are great or you don't think they're great, one way or another, your finances are going to change.
Yeah.
You need to take care of it.
Well, to me, these are things you want to pay attention to, but the things you do on the margins, right? At the end of the day, like you should still save in your 401k plan.
Yeah.
Right. You still get your company match. You should still manage your cash flow, right? You should still pay attention to taxes. You should still make sure you have an estate plan, right? That has nothing to do, like, yeah, these things change. Maybe you're a person, God bless you. Maybe you have 10 million and, previously you're like, I'm good, but now it may drop to below 10 million and maybe you need to do some estate planning from a tax standpoint. Those are the people that are going to be more affected by anything. But at the end of the day, you're going to want to do your personal economy things, like keep making money, keep working towards a promotion, keep saving, keep investing, do all the things that you should be doing regardless of who's in office.
Keep paying for baseball, keep putting money in your child's e-wallet for the Scholastic Book Fair.
Oh my God.
The biggest racket ever.
My son last year bought the Guinness Book of World Records. He spent like $35 on this like 400-page book of Guinness World Record thing.
I'm impressed that at least massive. It was a book, Derek. I have to have, so it is Book Fair week at my children's school. You have to load money into this e-wallet. Don't worry, it's fake money that you can't get back. So once it's loaded in there, they got to spend it. Everybody got a set amount, and I have to have a conversation with my children that you have to buy at least one book.
What do they buy instead?
Calculators, journals, sticker books. My son last year bought like one of those like rocks that you dig fake plastic dinosaur fossils out of. That was $17. A little metal tin that looks like an iPhone filled with pencils. We find like the garbage, a Stitch poster. Those of you, I have a daughter who loves Stitch. Disney Stitch. We bought a Stitch poster, so we have to have a conversation every year.
How much money did you put in this fake wallet?
Okay, I put $30 because
that sounds like a lot of stuff for this $30.
Yeah, well, they do. That's the trick with it, though, is they do. And I started off giving $10, but like a lot of the books are like $11. So I realized that wasn't enough. And then my daughter, the first year, came home with like a calculator, which she spent all her money on. So now, again, it's a discussion. You have to come home with a book and you can use it. But, that's the stuff that you have to worry about, I think. And your personal economy is the little things. I want to have enough money to be able to do that.
Right.
Not everybody does, or not everybody has planned for it. But you can listen to all of this information that we're giving you. You can take what makes sense for you, but your personal economy, and I'm like latching on to that concept, Derek. I'm here for it. Your personal economy is the most important thing for you.
It is. At the end of the day, I've made money when Trump was in office. I made money when Obama was in office. I made money when Biden was in office. And I've done poorly at times with all of them. And generally the economy as a whole didn't really matter as much. It was kind of more about my business personally and what I was doing.
And your personal financial decisions that you're making during those times.
Right. So, I mean, there's going to be some things on the margin that'll impact you financially. We're not going to get into the other stuff. But, for the most part, you control what really happens to you. And that's the main message I want to get here. These are things we want to be aware of. I think we want to know, okay, now I know what a tariff is. Great. What can I do about it? honestly, not much.
Yep.
Tax Cuts and Jobs Act, that we could probably do some more planning around.
Yeah, I would agree with that. Awesome. Well, thank you for joining us in another episode, and we will see you next time.
See ya.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.